Hi everybody, hope you're doing well. With the end of 2021 fast approaching, now's an excellent time to start making plans to what stocks you would like to be picking up in 2022. Dividend stocks hold a special place in my portfolio, as with the cash flow generated it provides a solid foundation to build out from. I've got coming up in this video 5 dividend stocks that I feel each offer something different in terms of risk versus stability, low yields, high yields, dividend aristocrats, and dividend stocks recovering from dividend cuts. We'll run over some high level information I first look at when checking fundamentals, some more recent news and updates regarding each company. If you enjoy this video and find value in it, please drop it a like and subscribe to the channel. Stock number 1 we have is none other than Walgreens Boots Alliance, huge pharmacy led beauty and retail company which only a few years ago was trading at close to $80 per share, and this has came down quite drastically because of lacking growth drivers, and then the overall COVID sell off brought it down to below $40 for a period of time. They've just under 9,000 retail stores in the US and just over 4,000 retail stores operating under the Boots brand, providing a worldwide presence. Walgreens have been struggling to hit the heights recorded in 2018, but a turnaround play may be unfolding before our own eyes. 2019 and 2020 recorded fairly flat results, with revenue coming in at around $120 billion range, but surprisingly enough, this company had a fantastic year in 2021, with revenue reaching $132 billion, exceeding 2018's high of $131 billion. The share price has still remained fairly range-bound for the last 12 months, but the company has been making moves. These are some of the metrics that I like to look at when identifying dividend stocks: the yield, the payout ratio, the 5-year growth rate, and how long have they been paying dividends for. Walgreens, in my opinion, ticks all the boxes, starting near the 4%, low payout ratio of under 40%, a 5-year growth rate of over 5%, and they've been paying dividends for over 45 years. As per most US companies, these dividends get paid out on a quarterly basis. Looking at some of the recent historical data, we can see due to the share price coming down the last few years, the yield has been increasing from under 2% to reaching a high of over 5%. Yield on cost, for anybody that doesn't know, is the yield you'd be making from your initial amount invested. Holding good companies for a long period of time can offer some exceptional results. Walgreens is a very interesting one. If you bought this stock 10 years ago, your yield on cost would be about 6%, which is pretty good, but if you had been buying this stock as its share price was performing well, you may only be getting about 2% if you bought this between 5 and 7 years ago. Following a very simple red, amber, green system here, I've looked at revenue, gross profit, total shares outstanding and total debt to take a look under the hoods to see what's going on. Revenues in this case, I give it a green due to the improvement in the last few years exceeding 2018 highs. Gross profit gets in at ambers, it stayed pretty range bound about 28 to $30 billion. Total shares outstanding gets a green tick, with Walgreens buying about 14% of the amount of outstanding shares it had in 2017 through to 2021, giving shareholders a bigger piece of ownership. And total debt has went up quite a bit from $9 billion to $33 billion, giving this one a red. They have, however, been performing well, beating earnings estimates 4 out of 4 times. One of the reasons I feel that they've been performing well this year and potentially into 2022 is because they've been rolling out COVID vaccinations. This itself will be a nice cash booster, but what I'm taking from this is that this will be creating traffic through the stores, making people more likely to purchase items within the store whilst getting their vaccination and boosters. They've doubled down on their investment in Village MD, raising its stake from 30 to 60%. This looks to me like the avenue they're going to be taking, which they've identified as being a good growth driver for integrating healthcare alongside the pharmacy side of the business. And the last thing about Walgreens Boots Alliance, and that they may be giving Boots the boot, with potentially looking at selling this element of the business. The section I have highlighted mentions that this will undo a strategic partnership which has been in place since 2012. Very interesting times ahead with Walgreens, but I do really like the fact that this giant is being proactive in recognising growth drivers and backing themselves on it. Stock number 2 is a large, hugely diverse company, and this is 3M. 3M develop and manufacture a vast array of products that are required in all types of industries such as health and safety, transportation, healthcare and industrials. They offer bandages, tapes, masks, electrical components, infection protection, the list goes on. It's a company that's been around the block a few times and that knows how to weather any economic condition. Revenue has been range bound for the last few years, coming in at $32 billion, but analysts are expecting this to increase up to $36 billion in the next 2 years. How does 3M hold up in the dividend front? Well, in my opinion, they're another top stock in this category. 3.35% starting yield, 60% payout ratio, nearly 6% 5-year growth rate, and they've been growing this payment for 63 years. It did have a fantastic starting yield of 5% right on the COVID lows, and if you bought this stock 10 years ago, the initial buy, you would be generating nearly 8% yield on cost. 3M have been able to grow revenue slowly and steadily alongside gross profit. They've been buying back some shares, only about 3 to 4% of the outstanding shares in the last 5 years, but still buying back nonetheless. Debt, however, has nearly doubled from 11.6 billion to 19 billion, but it's coming down from the highs of 21.3 billion in 2019. Another beat here on all 4 of the last earnings reports, showing that the company's performance has been performing really well recently. And you only need to see the types of industries that they work within: automotive, home improvement, personal safety, biopharma and electronics, and we can safely say that in 5 years' time, all these industries are going to be larger than what they are just now, giving 3M scope to grow revenues. Stock number 3 is Cardinal Health, who operate as an integrated healthcare services and products company in the US and internationally. They provide customised solutions for hospitals, healthcare systems, pharmacies, ambulances, and they provide materials and equipment such as gloves, needles, gowns, syringes, surgical and medical products. So a huge pipeline of products in an industry that is going to be around forever. When you look at the revenue, it's been growing at a good rate from just over 120 billion in 2017 to 160 billion in 2021, with expectations of the trend to be its friend out to 2023, where 180 billion is expected. This is quite impressive, and what supports this business model is that although non-urgent surgeries have been getting delayed due to COVID patients, this has meant that all things Cardinal Health supply were still needed throughout each COVID wave, and now as surgeries in the hospitals are getting back to more normality, there's going to be pent-up demand for all non-urgent surgeries, which will play into the hands of Cardinal Health. Dividend yield is around about 4% with a low payout ratio of 35%, quite a low 5-year growth rate of only 3.16%, and a long and credible history of 25 years of dividend payments. The share price has been quite volatile in the last 5 years, offering starting yields varying between 2 and 4.5%. If you bought this 10 years ago, your yield on cost wouldn't be too dissimilar to the starting yield you'd be getting just now, as the share price has been coming down quite a bit in the last few years. Quick look at the fundamentals: growing revenue nicely, gross profit has been pretty flat, buying back about 12% of the outstanding shares over the last few years, and they've been paying off debt from 10 billion down to 5 billion, so a pretty strong balance sheet here for Cardinal Health. Recent earnings have been a bit of a mixed bag after a huge beat in Q2 2021, but they've since been struggling. But as I've said, with the pent-up demand for non-urgent surgeries, I think over the next 12 to 24 months, this point in time could be looked back upon as a good time to enter the stock. In their most recent earnings report, they beat on top line but missed on earnings per share. The CEO, Mike Kaufman, said that these results were in line with expectations despite seeing greater inflationary pressures, and that they announced they'll be buying back up to $3 billion worth of shares. Stock number 4 has been a really good performer in 2021, as most companies have had to adopt to a hybrid way of working, prompting a lot of companies to fork out and buying staff laptops, monitors and other personal computing equipment. HP has really benefited from this trend, and although it might not be as strong going into 2022, I still believe a hybrid working business model will provide HP with strong demand. Revenue had been flat and decreasing from 2018 out to 2020, but with the boom in 2021, this increased revenues from about 57 billion to 63.5 billion. The share price has been on a great run, so it's something to keep your eye on to identify your target starting yield. HP's dividend stats are fantastic, with a starting yield of about 2.75%, super low payout ratio of under 25%, and a very high 5-year growth rate of over 10%, and a decent enough track record of 11 years. HP's share price got hammered in 2020 and offered a starting yield of close to 5%, and if you pick this up with a favourable growth rate, this could offer some outstanding results. As the share price has improved, this has brought the yield down to some of its lowest levels in recent years. In this case, because the company performed so well, this one may be for the 2022 watch list. The yield on cost from 10 years ago would be close to 10% yield, but 9 years ago, as the share price crashed, this would have given you an eye-watering yield on cost of nearly 20%. Revenues up nearly every year from 52 billion in 2017 to 63.5 billion in 2021. Gross profit is up nicely, buying back lots of shares, with around 50% of the amount outstanding shares in 2017 being purchased, Total debt has stayed fairly flat and net debt up to 4.4 billion. It's an increase, but not anything that this well-run company needs to worry about. 4 out of 4 earnings beats, again, so performing really well. And the share price did hit a 52-week high on the strong PC growth rate. So HP is a company that has a safe and steady growing dividend with a starting yield of close to 3%. It's certainly not the worst starting yield, even as the share price hits 52-week highs. Stock number 5 is Energy Transfer. This company owns approximately 9,400 miles of natural gas transportation pipelines and 12,340 miles of interstate natural gas pipelines. It also sells natural gas to electric utility companies, independent power plants and local distribution companies. They own and operate natural gas gathering and natural gas liquid pipelines, processing plants and treating and conditioning facilities in Texas, New Mexico, West Virginia, Pennsylvania, Ohio, Oklahoma, Kansas and Louisiana. Revenue was performing reasonably well with growth of 30 billion in 2016 to 50 billion in 2018 and 2019. Due to lockdowns in 2020, this hampered the company's revenue. Analysts are expecting a V-shaped recovery and then some, with strong performance expected out for the next few years. As this is an MLP company, there may be tax implications, so please look into this further if you're looking to buy. The starting yield is over 7% with a low payout ratio from the recent earnings of 30%, and this dividend did get a dramatic cut in 2020, hence the 0 years of dividend growth. And just by looking at this chart with the dividend cut and the share price fluctuation, it's been a super volatile stock in the last few years. With positive outlooks, I think that right now could be an excellent time to enter into this company. Revenue and gross profit has been increasing pretty much every year, which is good, and unlike the other companies, Energy Transfer has been issuing shares to help fund acquisitions and raise capital. I guess the positive side to this is that they haven't been raising too much debt as well as issuing shares, with debt levels being pretty flat around 45 billion. Another mixed bag with one huge earnings beat out of the last 4 and 3 other misses. There has been some activity within Energy Transfer within the last month. In November, they announced that they expect a Q1 completion of the Mariner East 2 natural gas pipeline, which will increase capacity from 70,000 barrels of liquid per day to 345,000 per day. They've also completed a $7.2 billion acquisition of Enable Midstream, which will add a further 114,000 miles of pipeline across the US and generate more than $100 million in annual cost efficiencies. What makes this potentially a good dividend pick for 2022? Well, management have stated that they are due to increase distributions and start buybacks, which should provide some reassurance to shareholders. So there we have it, 5 stocks I like heading into 2022. I hope you enjoyed these picks. All have a good Christmas, and I'll catch you in the next video. Thank you.